Hey, what's good everybody? This is Sam Kwok here, one of the Kwok Brothers, and as you know, we have a ton of content in our channel talking about how to pay off your mortgage early and saving money on your interest. Well, with the really low interest rates as well as talks of hyperinflation, you're probably asking, well, Sam, is it really worth paying off your mortgage early, and is it worth to do that right now? Well, in this video, I'm gonna point out to two main traps that you need to be aware of in your mortgage if you don't wanna stay stuck in your mortgage forever past your retirement age. And of course, if you're brand new to our channel, we talk about housing market, real estate investing, and how to pay off your mortgage faster, so definitely stick around by subscribing to our channel. So let's get into it. Right now, we're dealing with the very historically low interest rates, and a lot of people are thinking, well, it may not even be worth paying down our mortgage, mainly because we're not even paying that much in our interest. The other thought is, well, there's talks of hyperinflation, therefore inflation would go ahead and eat out the interest that I would pay over the next 30 or 15 years. But the problem is that most people don't talk about the social economic behavioral change that we've experienced the last 20 to 30 years. And that change has set up a perfect storm for what I like to call the two traps in your mortgage. So trap number one has to do with how often you move. Now, the US Census Bureau study shows that the average Americans move 11.7 times in their lifetime. So let's say the average person lives up to be 80 to 100 years old. Well, if you do the math, a person could move every 7 to 10 years. And the reasons may vary. You may choose to move because your kids move out of the house, so you downsize. Maybe you find a new job across town, or you move out of the state. So you decide to sell your house and buy a brand new house, in which any of these cases, it involves in selling your home and moving and buying a new home. So here's a trap that gets triggered every time you move every 7 to 10 years. So what I'm drawing for you guys is something called an amortization schedule, or I would like to call it the amortization chart. Now, this chart has two lines. The line that goes up and down represents your monthly payment. So let's say in this example, your monthly payment is about $1,000 a month. Okay, and the line that goes left to right represents the amount of time you spend in paying down your mortgage. So of course, on the very left side, you got 0 years, and as you go on, let's say you have a 30-year mortgage, well, the very right side of the chart is your 30-year mark. So of course, the more and more closer you get to the 30-year mark, you're paying down your mortgage. Now, with your $1,000 mortgage payment, there are two parts. First is the interest. So I'm gonna draw the interest line right here, and that's the interest you pay in proportion to your monthly payment. So out of the $1,000 a monthly payment, a vast majority of the interest you pay is actually upfront in the beginning portion of your mortgage. Now, the second line I'm going to draw for you guys is the principal you pay over time in proportion to your monthly payment. Again, one thing that you'll notice is that in the very beginning of your mortgage, vast majority of your $1,000 hypothetical payment is going towards interest. And a very small portion of your $1,000 monthly payment is actually going towards principal. Now, to break this down even further, principal is what we want to pay down. The more principal we pay down, the more equity we build. That's the actual mortgage amount that we need to pay. Now, of course, interest, as you guys know, is the fee that we pay for borrowing that money from the banks. So in the very beginning of your mortgage life cycle, in the first 5 to 10 years of your mortgage, vast majority of your monthly payment is going towards the interest, and therefore it's feeding the pocketbooks of the banks. Now, remember how I said the average Americans move 11.7 times in their lifetime, which is about 7 to 10 year mark. So let's say this line right here is your 7 to 10 year mark. Well, if the average Americans, homeowners, move every 7 to 10 year mark, and they make it to this point right here, all you've done in terms of your mortgage payment has been contributing towards interest more so than your principal payment.
Come on, man!
So let's say you do make it to the 7 to 10 year mark, and you sell your house and you buy a brand new house, get a brand new 30-year mortgage. The question is, do you get to continue making the progress you've made so far for the past 7 to 10 years? Yes or no? No, right? You'd have to start all over from ground zero to back to 0 year mark, where vast majority of your monthly payment is again going towards the interest payment. Now, of course, yes, you can get a shorter amortization. You can get a 15-year or 20-year or 25-year amortization instead. Even then, you're still dealing with the fact that most of the interest will be paid upfront towards the earlier part of your mortgage life cycle. So what happens is you're in a perpetual cycle where you make it to the 7 to 10 year mark, you sell your house, get a brand new home, and you're doing this constantly over and over again, where vast majority of all your monthly payments thus far has really been just interest, and you're shoveling cash and profit to the banks instead of building equity and paying down the principal for yourself. And again, my point is, it's not till the later part of your mortgage life cycle to when your monthly payment is actually contributing more towards the principal pay down. And that is trap number one. And noticeably, a lot of Americans are moving more often today than the past few years. Back in the day, in the 60s and 70s, as you may have observed, a lot of people usually stuck around, bought a home, stayed there for 30 to 40 years, stayed and worked for the same company for the 30 years, retire, and let the company's pension take care of you. Well, now these days in 21st century, we don't see that a whole lot anymore. We see a lot of transitory jobs, moving job to job, moving from company to company, going from one state to another. You know, we're dealing with a massive migration right now from California to Nevada, from Illinois to Tennessee, New York to Tennessee. So we're seeing a lot of movement, and nothing really is guaranteed as far as long-term housing anymore. And for someone to make an argument against trap number one, they would essentially have to believe that one could live in the same place, same house for 30 years, and they're 100% certain of that, which, as you know, it just sounds a little absurd. But let's assume that you don't move and you stick around for 30 years or more, and that's how it's gonna work. Well, this is where trap number two comes into play. So going back to the 7 to 10 year mark, which I'll draw a line right about here, represents the 7 to 10 year mark, often happens is that your local mortgage broker or your banker may come and say, hey, Mr. and Mrs. Borrower, congratulations, you've been doing a great job in paying off your mortgage in the last 7 to 10 years. Hey, tell you what, come on down to our office and let's go and take this $1,000 monthly payment and let's go and get it down to, let's say, $900 a monthly payment. And of course, what most bankers and what most mortgage brokers are alluding to is a refinance mortgage. So if you choose to go and refinance into another 30-year mortgage for the sake of saving, quote unquote, $100 a month, because you went from $1,000 a month to $900 a month, unfortunately, most unsophisticated homeowners and borrowers are thinking, oh my gosh, we're saving money, this is a great deal, oh my gosh, thank you, Mr. Banker, Mrs. Banker, this is such a great opportunity. But little do you know is that if you make it to the 7 to 10 year mark and get another 30-year refinance, what happens is you make it to this zone, right? You make it to this wall, you have to start all over back to square one if you receive your mortgage to where vast majority of your monthly payment, the new $900 monthly payment, is going towards interest. Had you just stuck around and not refinanced, you would continue on with the progress where more and more of your monthly payment is actually going towards principal pay down. This is why we see a lot of 60 or 70-year-old retirees still have 20 or 25 years left to go on their mortgage, and they're freaking out thinking, oh my gosh, like, how am I gonna get rid of this mortgage? And some people, honestly, and let's be real, have this fear that their mortgage may even outlast their own life. So as you can see, despite the low interest rates as well as talks of hyperinflation, well, if there's this constant loop of never-ending payments of interest payments, and most of your payments are actually going towards the interest, where do you ever get the opportunity to actually make a contribution towards building your equity, building your wealth, and ultimately paying down your principal balance? And same goes for student loans as well. If people choose to refinance into a 30-year plan or take an affordability payment plan, this is the cycle that people are stuck in, and they never get to pay off their student loans. So think about this, it's kind of a double whammy. Not being able to pay off their mortgage forever because they're in this perpetual cycle, and at the same time, not being able to pay down your student loans. I mean, this is a perpetual interest-making machine for the banks, and this is a trap that we need to get out of. And unfortunately, banks like this, they love this, they want to continue having you stay stuck in this trap forever, and make it sound like you're saving money and make it sound like you can stick around because of the low interest. But in all reality, with the social behavioral change, it's a lot tougher to actually pay down your mortgage in time. And worst of all, please do not refinance your car loans. So even with the facts that I've shared with trap number one and trap number two, a lot of you guys will disagree with me, and that is okay. But if this gives you an epiphany, and if you're thinking, oh my gosh, I didn't realize this, well, go and comment down below. Let me know what you guys think, and we'd love to have a conversation with you guys as far as what's going on with your mortgage. And if you're wondering, how do you get out of this trap? How do I pay off this mortgage earlier with a better tactic? Well, I have a strategy that's been helping over 1,000 homeowners paying off their mortgage faster I'm gonna just take a look at all these results down here, and you can see it coming up and down. And I will show you exactly how the strategy works, especially if you don't want your mortgage outlasting your life. We definitely don't want that. So go and definitely check out that video where I'll explain the strategy, how it works, and how it can pay off your mortgage faster without refinancing, making more money, or paying extra into the existing principal balance. That's right. So definitely go check out the strategy. Do subscribe, and if you love this video, go and smash the like button. Definitely help us out with our YouTube algorithm. But with that being said, go and definitely check out the second video, and I'll see you there.